For decades, the global economy quietly rested on a single deal, an agreement so understated that most people never knew it existed. Yet this silent pact decided the value of money, steered world politics, and turned the US dollar into the most powerful currency on Earth. Today that foundation is shifting. And the question echoing across financial markets is simple. What happens when the currency that ruled the oil age starts to lose its crown? In 1974, a discreet handshake in the deserts near Riyadh quietly reshaped the global financial order. It wasn't a public treaty, it was a strategic deal. Saudi Arabia would sell oil exclusively in US dollars, and the US would guarantee the kingdom's security. This agreement created the petrodollar system, turning the dollar into the lifeblood of global energy trade for 50 years. But now that pact has quietly dissolved. Saudi Arabia, once the pillar of America's monetary dominance, has begun accepting yuan, rupees, and euros for oil. For the first time since the Nixon era, oil is no longer tied solely to the dollar. What looks like a symbolic shift is actually a deep structural change in global finance. To understand why, we need to revisit the origins. When Nixon ended the gold standard in 1971, confidence in the dollar collapsed. Inflation surged and foreign governments dumped US currency. Washington needed a new anchor, something with global demand strong enough to replace gold. Oil became that anchor and Saudi Arabia became the gateway. The 1974 arrangement worked flawlessly. Every nation needed oil and therefore every nation needed dollars. This allowed the US to run massive deficits, print money freely and still retain global trust. The petrodollar created a quiet economic empire, not through armies but through invoices and settlement systems. But the world has changed. China is now Saudi Arabia's biggest customer, paying in yuan. The US, thanks to the shale revolution, no longer depends on Middle Eastern oil the way it once did. Riyadh sees America's regional influence shrinking while China, India, and Russia expand theirs. Saudi Arabia's decision to join BRICS in 2023 signaled this realignment clearly. By diversifying currencies, Saudi Arabia protects itself from US sanctions, dollar inflation, and political pressure. But this shift also weakens the mechanism that once supported America's low borrowing costs. For decades, countries recycled their petrodollars into US Treasury bonds. Now that steady demand is fading. Foreign central banks are reducing their treasury holdings and buying gold in record amounts. This is the hidden danger. If fewer countries need dollars for oil, they need fewer US bonds as well. With US debt above $35 trillion and interest payments surging, this shift matters. The dollar's dominance isn't disappearing overnight, but its foundation is weakening. China is building alternatives. Since 2017, Beijing has operated the Shanghai Energy Exchange, where oil is priced in yuan convertible into gold, China's version of a petro-yuan. Russia, Iran, and African nations already use it. Saudi Arabia is now participating, even testing cross-border digital systems like mBridge. This doesn't replace the dollar instantly, it creates a parallel financial system. The US can no longer weaponize its currency as easily through sanctions or banking restrictions. Russia's resilience after 2022 proved that nations can function outside the dollar system. For Saudi Arabia, trading in multiple currencies is not anti-dollar, it's pro-sovereignty. But as countries diversify, the dollar becomes increasingly domestic. American corporations borrow in dollars. US banks operate in dollars. Washington funds itself through dollar-denominated debt. With fewer foreign buyers of treasuries, the US faces two choices: raise interest rates or print more money, both painful. As the petrodollar era fades, the world moves toward a multipolar currency system. Oil may soon be priced in a mix of dollars, euros, yuan, and even gold. That means more volatility but also more independence for nations. Meanwhile, gold is making a comeback. Central banks aren't buying it for tradition, they're buying insurance. China's gold convertible yuan contracts help make the yuan useful without giving up capital controls. For Saudi Arabia, this hybrid system offers maximum flexibility. Trade in yuan with China, rupees with India, euros with Europe, and dollars when it's convenient. But stepping away from the dollar also means leaving the stability and deep liquidity of the world's largest financial system. And that's the risk Riyadh is willing to take. The United States still sits at the center of the world's largest and most transparent financial system. Even with its flaws and political storms, global investors trust American markets more than any others. So while many nations are beginning to diversify away from the dollar, that doesn't automatically signal a dollar collapse. It simply means the dollar will, for the first time in generations, have to share the stage. But for Washington, this shift represents a real loss of influence. Having the world's reserve currency wasn't just an economic advantage, it was America's greatest geopolitical instrument. It financed military power, foreign policy, and entire eras of prosperity. Losing that privilege, even slowly, will force the US to operate within tighter financial limits. The real question is not whether this transition unfolds, but how quickly. And to understand the pace, we need to examine what Saudi Arabia is planning next, its embrace of digital money, its deepening integration with China's financial systems, and how these developments could speed up the dollar's decline. Because Saudi Arabia is not simply stepping away from the petrodollar, it is stepping toward an entirely new financial architecture, one that is digital, multipolar, and far more controlled than anything the world has previously known. At the heart of this shift is programmable money. Central bank digital currencies, or CBDCs, are emerging as governments seek to modernize their monetary systems and build rails that bypass the traditional dollar-centric infrastructure. China's digital yuan is already active across dozens of cities, with billions of transactions processed. The UAE, India, and Singapore are running trials for cross-border digital payment networks. And Saudi Arabia has joined China's mBridge project, a direct attempt to conduct international trade without relying on SWIFT or the US dollar system. The mBridge initiative is, in simple terms, a blockchain-based highway linking central banks directly. Instead of routing payments through financial hubs in New York or London, money can travel instantly between Beijing, Riyadh, Abu Dhabi, and Bangkok, each in its own currency. When oil starts trading through that network, it becomes a historic bypass of the US-dominated financial rails that shaped the last century. That's why the end of the petrodollar isn't merely about oil pricing, it's about control. For decades, the United States used the dollar's dominance to oversee global commerce. With so many accounts denominated in dollars, Washington could monitor flows, enforce sanctions, or cut entire nations off from the financial system. That influence shaped geopolitics. But in the digital age, that control is slipping. Saudi Arabia watched what happened to Russia, Iran, and China. When your economy depends on a single currency controlled by a foreign government, you are exposed. A sanction, a banking freeze, or a system ban can destabilize a country overnight. So Riyadh is building its financial escape route. In the new world forming around CBDCs, multiple currencies will coexist, but all will be digitally traceable. Governments will have unprecedented tools to observe and regulate every transaction within their borders. And if Saudi Arabia integrates its energy exports into this framework, oil could become the world's first major commodity fully settled through digital money, an extraordinary leap from the paper-based dollar arrangements of the 1970s. But here's the twist. While this new system may weaken US financial dominance, it doesn't automatically translate into greater freedom for everyone else. CBDCs are programmable. They can include embedded rules controlling how money is used, where it can be spent, or even how long it remains valid. So while Saudi Arabia and China may be escaping the dollar's orbit, they may be constructing something equally centralized, with different leaders holding the keys. From Riyadh's perspective, however, this evolution is essential. The global energy landscape is shifting. Demand for oil is beginning to plateau as the world gradually transitions toward renewables. For a country whose wealth depends on energy exports, the future lies in controlling financial flows, not just physical barrels. By positioning itself at the center of digital oil trade, Saudi Arabia ensures its relevance in whatever energy future emerges. There's also a domestic dimension. Through Vision 2030, Saudi Arabia is attempting to reinvent its entire economy. Massive projects like NEOM, new technology hubs, and growing investment zones demand global capital. In a world moving toward multi-currency trade, Riyadh can attract investments in yuan, euros, or even digital dirhams without relying solely on US dollars. That gives the kingdom strategic flexibility and a direct hedge against American monetary policy. Now consider the ripple effects. The petrodollar system was never just a pricing mechanism. It was the foundation of global finance. Oil revenues earned in dollars were funneled back into US assets, primarily treasury bonds. This created a powerful loop, Oil exporters earned dollars, bought US debt, the US borrowed more, and the world received more dollars. That loop is breaking. As more oil is priced in non-dollar currencies, fewer dollars return to the US bond market. That means less foreign financing for US deficits, and more pressure on domestic investors, pension funds, and banks to absorb government debt. This shift is already visible. Foreign ownership of US treasuries has been declining as a share of total debt for more than a decade. The burden is slowly shifting inward. And here's where things grow dangerous. America's fiscal situation is deteriorating just as its global funding base weakens. Trillions in new spending, rising interest payments, and shrinking foreign demand mean the US government must either issue debt at higher rates or print money to fill the gap. Both outcomes erode purchasing power, a hidden tax on savers. Meanwhile, countries distancing themselves from the dollar are accumulating gold. Central banks purchased more gold in 2022 and 2023 than in any recorded years. The message is unmistakable. In a world where currencies serve as political tools, gold remains neutral. It is the only form of money that is not someone else's liability. Saudi Arabia, China, and many smaller countries are strengthening their gold reserves, not to return to a classical gold standard, but to add credibility in a global system where trust in fiat money is weakening. Holding gold signals the ability to settle trade in something real. That is the quiet foundation of the post-dollar landscape. Not yuan supremacy, not euro leadership, but gold-backed trust. Still, transitions of this magnitude take time. The dollar will not vanish. Over 80% of global trade is still denominated in US currency. Financial markets depend heavily on its liquidity. What we're seeing is diversification, not replacement. Think of the British pound in the early 20th century. It dominated world trade for more than a century, but after World War I its power declined slowly over decades. The dollar is now experiencing the same process, only in reverse. A multipolar system will be more fragmented and more volatile. Global trade will become less predictable, transactions slower, and debt markets more sensitive to risk. The winners will be nations with real assets and flexible trade networks. The losers will be countries dependent on cheap dollar financing, including, ironically, the United States. As the petrodollar era fades, America will confront difficult choices: raise taxes, cut spending, or rely on inflation to erode the debt. Historically, governments choose inflation, the quiet erosion of wealth through continuous money creation. That process is underway. The Federal Reserve's balance sheet ballooned from under $1 trillion in 2008 to nearly $9 trillion by 2022. Every crisis, housing collapse, pandemic, banking stress, has been met with the same tools: more printing, lower rates, expanded credit. That cycle cannot last indefinitely. When the world stops recycling its dollar surpluses into US debt, the Fed becomes the buyer of last resort. And when that happens, savings lose real value. Americans may still earn in dollars, but those dollars buy less each year. Meanwhile, nations that built alternatives will gain leverage. China has spent 2 decades securing resources across Africa, Latin America, and the Middle East through deals denominated in yuan or barter arrangements: oil for infrastructure, copper for technology. These routes will withstand a weakening dollar. Russia, too, has tied its exports to friendly nations through non-dollar settlement systems. India and Brazil are exploring similar paths. The US will not collapse. It still has unmatched innovation, deep capital markets, and the world's strongest military. But its ability to dictate global financial rules will diminish. America will shift from conductor to participant, still important, but no longer indispensable. There's also a psychological layer. For generations, the dollar has symbolized stability, trust, and power. A world where that symbol fades will feel unsettling. The global financial system has rested on confidence in the dollar. When that confidence weakens, people seek new anchors: gold, Bitcoin, land, hard assets. And that is the paradox. The petrodollar brought stability, but at the cost of dependence. As the system dissolves, nations gain independence, but at the cost of stability. This is not a conspiracy. It is the natural cycle of monetary history. The gold standard gave way to Bretton Woods. Bretton Woods yielded to the petrodollar. And now the petrodollar is giving way to something new: a digital, decentralized, multipolar system reflecting today's divided world. The key question is how this transition unfolds. If it happens gradually through coordination, the world may avoid catastrophe. If it happens suddenly, through crisis, war or financial panic, the consequences could be severe. Currency systems rarely collapse slowly. They tend to break all at once when confidence disappears. History offers clues. When Britain lost financial dominance in the early 20th century, it took 2 world wars and a global depression before the dollar replaced the pound. If the dollar's decline follows a similar path, we could be facing decades of turbulence before a new equilibrium emerges. In the end, the story of the petrodollar is a story about power, how nations create it, use it, and lose it. Dollar supremacy was engineered through alliances and trust. Now that trust is weakening and the world is searching for alternatives. So when you hear about a currency swap between China and Saudi Arabia, or a central bank buying gold, or a new digital payment network bypassing the dollar, remember, these aren't isolated events. They are chapters in the same story. The slow, inevitable unwinding of the petrodollar era, and the rise of a new, uncertain financial world.